It's Brian Stevens over at Mortgage Shots of the National Real Estate Post. Hey, listen, we're going to be talking about the week in real estate and everything that's been taking place, the week in mortgage lending, and I think what we need to know and what could certainly help us out. So let's just jump right into this whole thing. All right, so let's jump right back into this thing. So the shelter price index year over year. Now, if you look at the vertical bars here, the vertical bars are going to be recessions. And we had a recession from 2008 to 2009. That was going to be the great housing meltdown. I've said this a whole bunch. When we look at the peak of the great housing meltdown, it goes something like this. But if we continue on this graph of the shelter price index, over on the right-hand side here, from 2022 to basically 2025, we see this massive, massive increase. This is going to mirror all the other graphs. In every graph, when it's going to come to delinquencies, home values, price index, inflation, we see it's kind of like the Grand Tetons, these two huge mountains, right? It's like Mount Whistler and Mount Blackcomb for all you skiers and snowboarders. But we have a 2008 meltdown and what we're going through right now. And, we see the steep inclines on the way up and the precipitous drop off on the way down. The only correction we haven't seen is the correction in home values, and as I've told you before, I certainly think that's coming. Now, if we were to look at any one of these graphs, and we have vertical bars on every graph that is going to be published by the St. Louis Federal Reserve in housing and mortgage lending, they denote these vertical graphs, which are going to tell you the years of the recessions and how long they are. And they hit, almost on a decade basis like a Swiss watch. And this goes back to literally 1920. So when you're looking at this right now, and we had a meltdown in, 2007, 8, 9, and now we're 26. We're 20 years removed from really a significant recession. We had one in 2020 from the whole COVID thing. But if we have had for the past 100 years, the past century, some form of significant recession on about a 10-year basis, we're long overdue. We have the biggest peaks right now, which suggests we're going to see the biggest troughs. The shelter price index, it's going to show the shelter CPI and the housing PCI. So the question then becomes, what is the shelter price index? And it primarily tracked by the United States Bureau of Labor Statistics. Okay, so we know what the BLS is. And that is inside the CPI, the Consumer Price Index, and it measures changes in housing costs for consumers. And as I say here, it heavily influences overall inflationary figures. It includes rent or your primary residence, owner's equivalent of rent if you own the place, reflecting market rents, and what homeowners would pay to rent their own homes respectively. So this index shows significant recent increases, though it's really kind of starting to cool off. What does a rental market look like where you're at right now? It's cooled off significantly, hasn't it? Or in basically most markets, if you're not in Burbank or some areas over in Manhattan, more or less across the country, we see our rent prices and our vacancy ratios increasing, rents coming down, and it's really mirroring what we're seeing in the housing market in terms of how many units that we're selling and the softness of the overall market. Right now, we're pushing close to 50% of properties right now have had a price reduction, meaning, half the houses right now are giving concessions. Well, we've already blown past that. Now people are actually starting to drop the prices on their house. We're not seeing the movement that we need to see. The movement we need to see, according to most analysts that I'm seeing right now, are talking between a 30 to a 50% cut in home prices over the next 2 years. So this is where we're at with our shelter CPI and our housing PCE. So the PCE inflation, let's look at this one a little bit closer, because the last graph just talks specifically about our cost of housing if you own or if you're renting, or what your expected rents would be on a property that you otherwise own. And again, we saw the massive increase in rent prices and sales prices, and that would be what your anticipated rent would be on the house that you currently own. And now we've started to see this massive hill drop off again. And I got to tell you, as a real estate agent or lender, here's what you need to know, is that you're not just competing with high sales prices on properties right now when you're showing buyers houses and you have buyers' reluctance and a buyer's inability to afford what's out there. Again, those values are going to continue to come down significantly. Now, when we go to the PCE inflation, you might be asking yourself, what in the hell is a PCE inflation? It's a personal consumption expenditures, and it refers primarily to us on goods and services that we're buying, represent about 2/3 of the economy in the United States. This is a key figure for inflation that the Federal Reserve uses for its 2% inflationary target. It's tracking pricing changes in items from cars to food to healthcare to housing. You name it, they're covering it. So this is really going to be a massive influence in terms of how we are judging inflation and how we see it today. And of course, we want to see this number going lower. So a zero inflationary figure is something that we haven't seen. And again, if you're looking at this over on the left-hand side, we haven't seen this since basically between April and July of 2020. That's where we had zero inflation. It wasn't really going up or down. In fact, prior to that, we saw inflation going in the negative, where your dollar was actually giving you a little bit more spending power than you had in the previous months. Now, of course, once we hit July of 2020, and since then, we have been basically above what the Federal Reserve has targeted as its 2% inflation rate. So this is great. This is characteristics of home buyers. The median age increased to a peak of 56 years old, up from 49 years last year. The median first-time buyer's age increased to 38 years this year. It increased from 35 last year, while the typical repeat buyer's age also increased, get this, to 61. Your average repeat buyer is a senior citizen. This ain't a good thing. And the average age of a repeat buyer is 61. All right, moving on. The lowest initial jobless claims reading is right now, and it's the lowest we've seen since 2022, which is just a couple short years ago. But I want to talk about, when we talk about jobless claims, there's something that's really important here that I think people are missing. Because we have jobless claims aren't as low as they could be, right now, that means our economy is doing pretty well. Bonds are already slightly weaker in the overnight session, but the jobless claims data won't be of any help. Initial claims fell to 191,000, and that's the lowest number since they've been in 2022 and one of the lowest readings since the 1960s. My God, that's great. Jobless claims are as low as they've been in the 1960s. The problem is, when they're calculating jobless claims, that's people who are actually looking for jobs. Did you know that? So if you decide that, you're just outside of the job market and you're not looking for a job anymore, you're going to make our jobless claims look a hell of a lot better. It probably wouldn't surprise you to hear that those who are on some type of government assistance, a subsidy, has gone up almost proportionally to our jobless claims. That means more people quit looking for jobs, have gone on some type of social assistance, and now they're making the jobless claims look better than they truly are. And how do we know this to be true? But here's the second part, and this is something that has to be looked at. There's a payroll company called Revilio, and the Revilio payroll count of 9,000 came out. So now than ever in the history of documenting our jobless claims, we have more people working second and even third jobs. Case in point, initial jobless claims, as we're looking at right here. You see that massive drop-off over on the right-hand side? That's 191,000, and man, does that figure look attractive. But look at this one. Continuing jobless claims. Whoa. How do we reconcile these two graphs? In other words, our continuing jobless claims look like this. They're going through the roof. If we look at initial jobless claims, they look like this. They're going straight down. One's going up, one's going down. One spells that things are going better for our economy, and one spells that things are going worse for our economy. So where does it land? And here's what's taken place, guys. We've had so much government intervention since COVID, really, and when we artificially brought mortgage interest rates down to 2%, because think about this. Your housing expense is the most expensive cost to 99.9% of people who live right now, and our housing expense has gone through the roof, both for renters and for homeowners. So what we did is we decided to have the Federal Reserve go out there and increase their balance sheet and buy mortgage-backed securities to the tune of billions and trillions of dollars. That brought rates down to, in the 2s and the 3s, and people are holding on to those. People aren't moving their properties. And when we saw massive demand for houses and builders quit building and sellers aren't selling because rates are at 2%, what happens? The values go through the roof, rents go up, inflation goes, just completely out of whack, and we've created an artificial market for which all of our previous indicators that we use are no longer as reliable. And this is case in point. Our continuing jobless claims are going through the roof. And of course, our initial jobless claims are dropping off. Now, I'm just going to talk about mortgage interest rates for a couple of minutes here. Over the past week, we saw the 30-year fixed rate actually tick up about 0.03%. Nothing really big. The 15-year fixed is unmoved. Your jumbo is ticked up just a tad. I mean, so small, this is hardly worth even talking about. They basically remain the same. Your 7/6 ARM is down a little bit. Again, not even worth talking about. And your FHA and your VA 30-year fixed rate meat and potato gubby loans are up a little bit. But again, so little, it's not even worth talking about. And if we look at the economists inside the Federal Reserve, the Office of the Comptroller of the Currency, the FDIC, Fannie, Freddie, Ginnie, HUD, if we look at all of their economists, the ones who have the Treasury, the ones who have their thumb on the pulse of interest rates, and the ones who are creating the policies in order to affect interest rates, all of them say don't expect to see any significant change. Listen, guys, I hope this helps. If you have any questions, make sure you pop me a comment down below.